Private credit is going through a bit of a golden era right now, but is it simply just dazzle and shine? As we understand more from the early adopters, we ask, why is it still so attractive, and what is it going to look like 6 months or even 12 months down the road? We're going to break that all down for you right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us. We're going to get into this conversation on private credit with my colleague from the Chief Investment Office, Jennifer Liu, and our guest from Blue Owl Capital Credit, Jeremy Lee. Thank you both for being here. Great to have you in the studio. This is a conversation that we're starting to have here on UBS Trending. We're talking about private equity a couple months ago, but private credit and debt has been becoming a little bit more of the conversation du jour. And Jennifer, you were with us a little while ago talking about this. So maybe you can again level set for our audience that may not know, what is private credit? Why is it interesting? Why are we talking about it so much right now?
So private credit refers to financing that's by non-bank lenders that is not traded on the public market. And private credit encompasses several types of credit. You have direct lending, you have venture debt, you have mezzanine debt, and then you have specialty financing. And direct lending makes up a large part of private credit. And what it is it's a loan made directly to a company. So for example, if you were to go and apply for a mortgage, instead of going to a bank, you would go to a private credit manager. And that manager will assess your creditworthiness, and they will negotiate the loan terms directly with you. Now, to your second question about why is it interesting? So we really have to take a step back. And right now we're in a rising rate environment, right? So direct lending is a floating rate instrument. And so it's really performed better than bonds. If you look at 2022, the 60-40 portfolio just didn't really work out that well. We had to sell off from stocks and bonds. And a key message from the CIO office is to diversify with alternatives. And if you look at portfolios that had a 40-30-30, with 30% going to alternatives, has performed better. Beyond 2022, if you look historically in a long 10-year horizon, direct lending has outperformed leveraged loans by 500 basis points. Mm-hmm. So floating rates. And then secondly, it's really having to do with supply. And if we go back to the GFC, we have tighter bank lending standards, we had a bank retrenchment, and then just recently with the regional bank crisis, banks have really pulled back on their lending. If you look at the end of 2022, the number of deals that banks were lending to private equity was near zero. And so this really allowed a chance for private credit managers to come in and take over and provide that supply that the banks were missing out.
It used to be that you could only get private credit through a bank, correct? I mean, that was like the old days. I mean, we're talking 10, 20 years ago.
So traditionally, you can go to a bank for broadly syndicated loans. So those were publicly traded. They get syndicated by many lenders. Right. Private credit then is fewer lenders, 1 to 3, and they're privately negotiated. So it's just a tailwind of rising rates, a lack of supply, and also private credit just become easier for investors to access these days.
Yeah, great. Thanks, Jennifer. Jeremy, private credit is getting a lot of buzz right now for those who are paying attention and keeping their ears open, and a lot of money is being raised in that space. Do you think it's too large is the question, and what differentiates one manager from another manager in this space?
So look, as I think about the growth that we've seen in the market, I would really look at it as more evolutionary versus revolutionary. And I think Jennifer raised some really good points just around the innovation that we've seen in the investment structures, particularly over the last few years, which I think have opened up the market to a broader swath of investors, particularly in the wealth community. So they are now able to access and really unlock the portfolio benefits associated with allocating to direct lending. So as we look at the market today, we don't think it's grown too much, right? You really have to think about this asset class in the context of the broader private equity ecosystem. And for every dollar of capital that's been raised or that's filtered into the direct lending market, about $10, if you look at the last several years, have been raised in private equity. So what that means is there's a mismatch in kind of fundraising trends, and that those committed pools of capital in private equity, as they get deployed, we're seeing today about $1.5 trillion to $2 trillion or so of dry powder. So as those committed pools of capital get deployed and invested, it's going to necessitate private debt financing solutions. So as we think about investment capacity, really the ability to continue to deploy in this market, that private equity growth is serving as a really big, we think, secular tailwind for the marketplace. And then
we also have, I just wanted to say, Jeremy, we
please.
have a chart I wanted to pull up, risk and return, and I think that kind of helps tell a little bit of what you're talking about here, if you want to maybe give that a go.
Yeah, sure. So as you think about private credit, I like to say that it provides or behaves well in a multi-asset portfolio. So you can really think about this investment strategy as being more of that constant all-weather solution. Kind of like how you think about fixed income, right, as the ballast of your portfolio. Simply stated, because in up markets, it's going to give you that yield premium to kind of public credit market alternatives, right? As Jennifer mentioned, we're lending directly to companies. These are not traded assets, so we earn an illiquidity premium and oftentimes a complexity premium. So in up markets, we're going to give you that yield premium versus other public credit assets, with the potential for growth depending on kind of where you deploy that capital within private credit.
Right.
But then also in down markets, importantly, we're giving you that consistent yield generation, right? That yield is directly derived from the interest rates we're charging on the loans that's driving most of your return. And then we're going to give you greater downside protection, given that these loans are first lien, senior secured. We sit at the top of an issuer's capital structure, and there's lots of private equity cushion typically that sits beneath our debt that really helps to insulate us from credit impairment.
Terrific, Jeremy. And I just want to say right here as we're sitting in this conversation to our listeners or viewers, make sure you're having conversations with your financial advisor about this. This can be sort of complicated. Obviously, there's a great opportunity here, so make sure you're talking to your FA about that and make sure it's right for your risk profile, et cetera. So, obviously we know that the size of the market for private debt is growing and it's expected to continue to grow over the next decade or so. But let's think more short term, because we are in a rising rate environment, although we're starting to see yields on the 10-year and 30-year maybe take a little bit of a dip. I'm not sure if we've hit the apex, but we expect the Fed next year will start to cut rates. At least they've indicated as much. Where do you think private credit goes from here over the next 12 months or so, Jennifer, given that it is a floating rate and we don't know exactly where rates will be a year from now?
Sure. I would say in the short term, in 6 months, we think private credit will benefit from higher base rates. If we are in a higher for longer environment for 12 months, then we might see some distress. But it's also an opportunity for private credit managers to pivot into more distressed debt, which allows investors to jump on that.
And Jeremy, let me ask you the same question then. If you wanted to look at the next 6 to 12 months in the private debt market, where do you see it going?
Yeah, sure. So as we look at the market today, we think the asset class is poised to continue to deliver really strong risk-adjusted returns, right? As you mentioned, Anthony, rates have obviously been in focus, right? We've been through this period where we've seen a big upshot higher, and now the fear, at least for the second half of next year, is that they're going to move lower. But I always like to remind investors, right? The higher rates is a positive development net for direct lending, because it drives earnings expansion in your portfolio, right? Our asset yields increase, and subsequently our distribution yields that we're paying to investors increase. However, the value proposition of direct lending is not predicated on rates being higher. And that is because, as we've discussed, regardless of the environment, rates are up, down, or sideways, we are always going to earn an illiquidity premium and a complexity premium, because the solution that we're providing, the capital that we are providing to companies, we almost view to be more alpha generative as you think about your portfolio. And if you look over time, it's partly why this market has generated about a 200 to 400 basis point yield premium to kind of public credit market alternatives. Those are durable over time.
Yeah,
right?
that's what makes it sound so attractive to any investor, is that it does do well in any rate environment. I mean, that's really a fascinating aspect of this. Jennifer, just take it home for us. We've got about 30 seconds. Last thoughts here that you could share with the audience.
I think private credit is a great opportunity to diversify from your fixed income portfolios. Key messages in CIO is diversify with alternatives. And with the new vehicles that have been coming up for investors, it's a great opportunity to take a look.
Terrific.
The market today is really attractive for underwriting new investments, right? We've talked about the pullback from banks, capital being scarce, right? That really continues to favor our capital and the solution that we are providing to companies. So direct lenders in many ways have been keeping the credit markets functioning, right? And we're able to do that today when yields are much higher, but also the terms that we are seeing on particularly 2022, 2023 vintage deals continue to favor lenders, right? So as you're thinking about how this is implemented in your portfolio, think about also just the opportunity set that we're seeing today relative to what we've seen over the last decade. One of the best risk-adjusted return opportunities we've seen for some time.
Great. Jennifer, Jeremy, thank you very much. As I said to our audience, it sounds like a complicated topic, and it can be for those who don't understand it, but I'm glad you were able to break it down and give us sort of the simplification of it all. And obviously, anybody should take a look at their risk profile, talk to their financial advisor, figure out if this is the right avenue for them. Thanks again for coming by to share it with us. I know we're going to be talking a lot about private credit over the next decade, so we're just getting our feet wet here. And that's going to wrap it up for us, everybody. Make sure to check out our website at ubs.com/views for more. For our Chief Investment Office, content is there for you. Plus, follow us on social media, particularly our Instagram page at UBS Trending. You're going to get content there that you're not going to find anywhere else. Plus, UBS is on all the other social platforms, so check us out. And always, again, talk to your financial advisor if you have any questions. Until next time, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. See you soon. They'll fix that.